So what we're looking at today in terms of the new topic that we're looking at is accrual accounting and adjusting entries. Now, accrual accounting we've actually already come across and dealt with. It's dealing with revenue recognition. Guys, dial it down a bit. Accrual accounting we've already come across, revenue recognition, expense recognition. We've been doing accrual accounting. That's what we've been doing. So that will take a very short amount of time. The adjusting entries is a really important aspect of what we need to look at. So what we're going to be looking at is describe how profit is measured and reported on the accrual and cash basis. So there are two different ways in which accounting happens, accrual and cash. Different organizations will use cash, different organizations will use accrual. Smaller organizations, generally speaking, are the ones that use cash accounting because they don't need to use accrual accounting. The types of stakeholders that they're dealing with that need to look at their accounts are not that many. If you think about most small businesses, about the only person they're really dealing with is the bank, and the bank can just request information off them as they need. So accrual accounting doesn't really help them too much. The second bit is identifying the four major circumstances in which adjusting journal entries are necessary. The third thing we'll be doing is then working through an example of this. And the fourth thing we'll do is look at the closing process. So accrual versus cash accounting. I have the document camera up for a reason which I'll get to in just a moment. So the difference between the two approaches is the timing of when we record revenues and expenses, and thank you for closing the door quietly. It's nice when that happens. Thank you too. It makes such a difference. So we've been doing this. So if you think about the airline example, just because there's such a big disparity in those 2 points, when someone pays for a ticket and when someone flies, when someone pays for a ticket, they pay cash for it, and even if they're paying credit card, cash is being transferred to the airline, and you're just dealing with the credit card as a separate thing. So the airline is receiving cash, and then they're taking then you're taking the flight. When you're looking at a cash-based system, the airline would record revenue when you pay the cash. That's when they get cash. That's when revenue happens for them. Under the accrual system, they record the revenue when you fly. So it follows when the thing happens. And you can imagine how the opposite of that works with expenses as to when you pay for something to when you use something. So those things don't always have to be at the same time. That's accrual and cash. What we're looking at in terms of the steps in the accounting cycle, and this is why I want to refer to this, and I will keep using this, it's a really good navigation tool, is things happen and we end up with financial statements. Up until now, we've added in these key elements, being the journal entry, posting to the ledger, and the trial balance, which I can't quite read. And then we took this and we created the financial statements. What we're going to do is sort of break that link, and we're going to add in a fourth thing down here, which is adjust, or the adjusting entries. So instead of going straight from here up to the financials, we're going to come down to the adjusting entries. Then we're going to come up with an adjusted trial balance. So again, we've sort of just deviated one extra bit, come up through to an adjusted trial balance. And then from that adjusted trial balance, we end up with the financial statements. So the financial statements get made the same way off the trial balance. It's just we've tweaked that trial balance to take into account some really important things which have happened, which we haven't had actual entries for. The last thing we need to do, so we end up with a nice set of financial statements, everything's taken care of, everything's looking good. There's then the closing process which takes place. And there are some important aspects as to why that happens, which we'll get to when we get to it. But we've got this thing, we just got to wrap things up. You just don't leave things hanging. We've got to sort of tidy some stuff up at the end. And so we'll look at what that is and why that is, and it's relatively straightforward. Slightly out of order. But accrual versus cash-based accounting, we know this. Smaller businesses generally use cash-based accounting. Larger businesses are required to use accrual accounting. So if you're using Australian accounting standards, if you're a listed company that has to follow the Corporations, that follows the Corporations Act and is required to, do various things, they've got to use these standards. If you're a large company which isn't listed, generally speaking, you're often required to use these sort of things. If you're government entities or governments, you're generally required to use these sort of things. If you're not-for-profits, depending on how big you are, you may be required to do these sort of things. So a lot of businesses get picked up using accrual accounting. So what we're going to look at here, moving on from that, are 4 adjusting entries that take place. And I'm going to pick this up with reference to one of the things we just looked at. So if I can find it. So if you can refer back to the example that we were just doing, and if you look at what happened on March the 27th, on March the 27th, we paid employees' wages. So those are people that have worked for us sometime before March the 27th, because generally speaking, most people get paid after they've worked, not before they've worked. So these people have worked for us. We paid them on March the 27th. Let's assume they got paid that March the 27th, they actually worked that day and got paid for that day, and then their pay happened right at the end. What that means though is, link it back to what is up here on the slide. Accounting does not record transactions as they happen, it records them when something significant happens. So if we think about it from an employee salary point of view, employee wages point of view, a company or an organization will generally only record a transaction when employees are paid. So, we get paid here on a fortnightly cycle. So the university will only have an accounting transaction, and there's quite a few employees here. They'll only have an accounting transaction when all, however many thousand of us get paid. And it's a little bit more of a complicated transaction than just debit, salary, expense, credit, cash, because there's leave entitlements and there's various superannuation and various things in there. But effectively, for what we've been looking at, it's debit, wages expense, or debit, salary expense, credit, cash. But if we look at this example we've got up here, the period ends on the 31st. And we will still likely have people working for us on the 28th, and we'll have people working for us on the 29th, and on the 30th and the 31st. So if we leave it at where it is, we've had 4 days worth of people working for us, and there is no reflection in what we've just done. What the adjusting entries are doing is picking up the fact that we've had 4 people working for us in this case, and we haven't had a transaction yet. Because if you think about employee wages, in that 2 weeks I work, should they record every day that I work? Should they have a little transaction for every day? At the end of each day, the system updates the fact that we've had employees work a day, and then they do the next day. Or should it be the fact that I work 8 hours every day? So should it be they do it each hour 8 times a day? Should it be every minute within that? Like, you could reduce it down to, you could record a transaction for every second. It could keep getting that minute, and it would have absolutely no purpose. There's no reason to do that. So what happens is, for wages, they just get done when people get paid, and then you just have a final adjustment to pick up the few days where someone has worked and there has been no transaction. That's what we're going to be looking at. So adjusting entries are made to record revenues and expenses that have been earned or incurred but not yet recorded. Recording and posting is the third step and gets done after the trial balance is prepared. So we do this, we do the trial balance, and then we look at all the adjustments that need to be made. 2 main types, and you can kind of categorize them together. There are 2 revenue types, there are 2 expense types. And in essence, it comes down to, do you pay for something before, with revenue, do you receive money before you earn it? Or do you earn it and then receive the money? And with the expenses, prepaid and accrued, do you pay for something before you use it? Or do you use something and then you pay for it? We're just separating out the payment and the using of these things So one time the payment happens before, or you receive the money before, or one time the payment happens after and you receive it after. That's all that we're doing. And look, some of these we're sort of touched on. Some of these will be familiar to you as just ideas. So these aren't meant to be complicated things. It's just an additional layer of stuff that we need to do. So deferred or unearned revenue. Now the way that I'm going to work through this, and partly it's because, as you probably noticed, so I'm using a laptop here because these are getting recorded. So I know you guys have got the content for this on your, either as printed out or on soft copy. So I'm going to actually work through this stuff through the Excel spreadsheet, just so that when you're reviewing this, it's going to be present on the video rather than you just listen to me writing up on a board, which doesn't really work for a secondary viewing. So when a company receives cash before it provides a service, it is deferred revenue or unearned revenue. So this is Qantas. This is Qantas receiving cash for their tickets. But it's not only those sort of things. So for an example, a company sells a 12-month subscription of its monthly magazine. On the 1st of October, the company receives a total of $1,200 for 20 subscriptions. The company's financial year ends on the 31st of October. Now, I don't know how many people have monthly magazine subscriptions anymore. I mean, it's not a common thing. But we do see these sort of things pretty regularly. These sort of, if you think about how a lot of software services and a lot of cloud services are provided to us nowadays, it's this sort of license model. If you have Adobe products, generally speaking, and pay for an Adobe service, you can't just buy the software off the shelf and have the DVD and load it up and it's yours now. You pay for a license for it, and you pay a recurring license, whether it be month by month or year by year. If you want extra space on Dropbox, you pay a 1-year service. If you want extra space on iCloud, you pay for a 12-month service. So this is actually a pretty common thing. Obviously not, maybe we just need to change it from magazine subscriptions to a Dropbox service, just to make it a little bit more contemporary. But the idea is still the same. So on the 1st of October, they received a bunch of money from people. They've not provided anything at that point in time. 1 month later, they provided some of the service. We need to show that they provided that service, or at least partial amount of that service. So what I've got here is, this is the same document that you have, but I've just cleared out the entries so we could just talk you through them as we're going through. Now with them, just importantly, not every one of these entries is an adjusting entry. Some of these are the actual entry which takes place, but it's good to see the actual entry before we do the adjustment. So this entry is the actual entry which takes place. This would be recorded as part of the just normal trial balance. We received cash for $1,200, so debit cash $1,200. We have credit unearned subscription revenue, credit $1,200. Cash is an asset, and the asset is increasing. If I can make it happen. So we debit cash asset, and unearned subscription revenue is a liability because it's reflecting that we have an obligation to provide these 12 magazines, or this 12-month magazine service, or good, I should say. So $1,200, $1,200. The adjusting entry, when it happens on the 31st of October, this is the adjustment. We reduce the liability, debit unearned subscription revenue, 100. That's because we've done 1/12 of it. So that's 1/12 of 1,200. We now only have an obligation to provide them another 11. We credit subscription revenue because we now have earned revenue. So we debit the liability, we credit the revenue. This is when the revenue takes place to show that we've earned it. So that is the adjusting entry. So that is a deferred or unearned revenue in the sense that you got paid prior to doing it. When it comes to accrued revenue, it's the flip. It's you've earned revenue before you've received the cash. Now look, for the stuff that I do outside of here, when I invoice, like I get paid after I do the work. Generally speaking, I'll do the work, I'll invoice them, and then they'll pay me back. The thing is, I don't do accrual basis because I'm not big enough to worry about that. So I'm just worried about the cash flow. So that's all I really care about. But that's how a lot of my consulting work happens because I'm doing work first, then get paid. The adjusting entry at the end of the accounting period needs to deal with the fact that it's been earned but not yet received. With this one, we need a timeline here to help us because, I'll get rid of that. Just to help you kind of identify when things have happened. So in this case, on the 23rd of September, we've finished the work done. Now that could have been happening prior to then, but the work is done by then. 30th of September, that's the financial year end. So I'm doing it with the dashed line to make it really clear what happens in what period. On the next bit, 10th of October, 21st of October, 10th of October, we send the bill and we're paid. Now, to me, that's a pretty rubbish accounting practice if it takes them nearly 3 weeks to send out a bill, but suits our purposes here. So the work gets done in this period. If we had no adjusting entry, what we'd end up with is on the 10th, we would debit account receivable 1,000, credit revenue 1,000. But that would mean the revenue happens in that period. Now that's not when it happened. The revenue actually happened the period before. So the adjustment, all the adjustment we're doing is basically making this entry as the adjustment. So when we see it, and the adjustment happens on the 30th of September, so the account receivable is the asset and that's going up. Service revenue is the revenue and that's going up. And that's happening on the 30th of September and that's the adjusting entry. Because we're getting that revenue into the period it's meant to be happening. All right, prepaid or deferred expense. I would hazard most of you guys rent, right? Rent, sorry, I'll preface that. Rent where you live, I'd imagine you pay rent on where you live. You do, your parents, somebody's paying rent for where you live. I'd guess. You might own your own place, good luck, so well done. But you may well be paying rent. Do you pay rent after the fact or before the fact? Yeah, you pay before the fact. So anyone pay fortnightly? No, monthly? Yeah, so monthly. So you pay for you pay a month in advance. You pay now and that gets you, that's a prepaid expense. You're paying for something now to get you use for the next however long. That's a prepaid expense. So all that we're doing is then reflecting here, when you pay for it, it's not an expense. At the time you pay for it, it's not an expense because you haven't used it yet. At the time you pay for it, you are getting a benefit because you get to use it. And then as you use it, as you consume it, then it becomes an expense. But for most of us in our personal lives, and I'd be maybe worried if you guys were to start doing accrual accounting for your own budgeting, your own account purposes. Look, I don't do that. So I mean, when I pay my car rego and my car insurance, which seems to just, even though my car's getting a year older each time, and I should be technically getting less risky because I'm getting older as well, car insurance just seems to be going the other way, so I don't quite know how all that works. But when I pay my car rego and I pay it like in one hit, and car rego, car insurance, I don't do month by month, that's a big, over a 12-month period, so that's a big expense in 1 month or in 1 week. But then for the rest of the time I use it, I'm not paying anything. So from a cash basis point of view, I've got this massive expense in one of the months, and then zero expense for the car for the rest. But I use up that expense, I use up that insurance over the entire course of the year. So really what I should be doing is recording an asset. I got this insurance asset or this registration asset. And then as I use up and I drive over the course of the year, I consume a little bit of it each time. And so I actually sort of spread it out across the time that I'm using it. And that's what a prepaid is. And that's actually what is going to happen here, in that on the 1st of March, a company purchased a 12-month general liability insurance policy for $36,000. When they buy it, that's not an expense for them because they get the benefit and they'll consume that over 12 months. So at that point in time, it's an asset, and a month later, on the 31st of March, that's when their financial year ends. So at that point in time, they've consumed 1 month. So what we do with this is a 2-step process, the first being the actual entry, the second being the adjustment. So for the prepaid or deferred expense, the initial purchase is a prepaid insurance account, and this is an asset. Come back for there. And that's an asset, that's $36,000. When we use it up at the end of the month and when the adjustment takes place, like that. Because you've used up, that's for 12 months, you've used up 1 month of it, so that's 3,000. So that is on the 31st of March. That's the adjusting entry. And this is a prepaid insurance asset. And that's the asset reducing because now you've consumed 1 month of the 12, you only have 11 months of insurance left. So that is prepaid expenses. The last one is just the reverse of that, funnily enough. So the last one is where you incur expenses and you pay for them later, and that's an accrued expense. And this is where you've got to show an expense for something which hasn't yet happened. An example with this one, it's actually good to draw up what days of the week they are. So Monday, Tuesday, Wednesday, Thursday, Friday, Saturday. This is payday, but that's the end of the financial year. So that pay is picking up the workers working Monday, Tuesday, Wednesday, Thursday, Friday. So this expense for the workers actually happens in this period, but the transaction, had we not have an adjustment, would happen in this period. So all that we're doing is, at this point in time, making sure that we reflect the expense of these guys and show there's an obligation to pay them whatever that they're due. So the entry for that would be wages expense, and that would be 5,000. Accrued wages, and that's a liability, and that's 5,000 because it's 5 days at $1,000 a day. So that picks up the expense and the liability. So now that we've got the expenses to where they need to be and the liability to where it needs to be. So those are the 4 types of adjusting entries. We're working through this at a rapid rate. So the summary, you've just got the 4 types: cash before, cash after revenue, cash paid before, cash paid after expense. deferred revenue, accrued revenue, deferred expense, accrued expense. When cash is received before or paid before, you will have some sort of entry which takes place beforehand. Regardless of that, you will have an adjusting entry for each 4 of these, and when cash is received after, cash is paid after, you've got an entry, an entry. And if we actually look at them, and we're just going to step through each of these quickly. If you were to merge these 2 entries, and these 2 entries, and these 2 entries, and these 2 entries, liability gets knocked out, you end up with cash revenue. So it's just debit cash, credit revenue. Receivable gets knocked out, debit cash, credit revenue. So we just end up with a debit cash, credit revenue. Either way, we're just separating them out. Prepaid asset, match off, debit expense, credit cash. Payable, match up, debit expense, credit cash. So ultimately, we're just separating out that debit expense, credit cash, or the debit cash, credit revenue, and just separating them out into 2 entries. Now, 2 big things to remember. The first is, and we'll look back at the examples we've just done, the first is that you'll always have an asset or liability affected and a revenue or expense affected. Always. And secondly, and really importantly, and the thing which semester after semester always kind of bugs me, is an adjusting entry never, ever has cash in it. Ever. The whole point of the adjusting entry is you're dealing with it after the fact. If a cash had been involved, it would have been an actual entry. So if you find yourself starting to put cash in something, slap yourself and just go, no, that was the wrong thing to do, and then just sort of start again. Never involves cash. And if we look at the example we have here, well, I should say that's an adjusting as well. This is an actual transaction. It's got cash involved, so you actually have a transaction. This is the adjusting. It has a balance sheet amount and it has a profit and loss statement amount. Nothing cash. Balance sheet amount, profit and loss amount. This is cash involved because it's an actual transaction. Expense, profit and loss amount, asset, balance sheet amount. No cash. Expense, profit and loss amount, liability, balance sheet amount, no cash. Adjusting entries follow those rules. So that is, well, those are the examples that we were working through. So the next thing we're going to do is actually work through this in a little bit more detail based on what we've got from Circle Films. Now this is the information we have. So we had a trial balance, this is where we got to last week. Various assets, liabilities, equity, all the rest of it, all the things up there, $31,000. Now, certain things have taken place to get to that, and we also have now some new information. And the additional information that we have is, previously, if you cast your mind back to last week, we got a deposit to film a wedding anniversary. We've now done that. We've also then filmed 50% of a job, of which we've yet to invoice them, and we'll get paid $1,500 for each night. Thirdly, we purchased 1,000 of supplies. We had purchased 1,000 of supplies during May. After a physical count, Circle Films determined that it had 650 of supplies remaining. Fourth, the interest rate for the promissory note is 6%. That promissory note was $9,000 and we've used it for 1 month. So that's 6% per annum. And lastly, Circle Films estimates that depreciation on its 2 cameras total $600. Now with this, we then sort of step through and we do the entries for each one. Now I'm just going to have, I suppose I'll walk through this. If you've already sort of had some thoughts around it and wanting to put some stuff down, feel free to do that. Obviously, these sort of things we'll be dealing with and you guys will be doing next week. So this is an opportunity to sort of step through it, see why we're doing it. hopefully you're making calls on things and it lines up with what I'm doing. But let's see what we get to. So what we have is, we filmed something. There it is. We had filmed something, and if you go to the trial balance, I've stripped this out. We'll talk about this in a moment. But if we go to the trial balance, we have an unearned revenue of $2,000. That's the deposit we got because we got paid for something we haven't yet done. We've now done that work. So in terms of doing that work, it's unearned revenue, which is the liability, and it's service revenue being credited, which is the revenue, and the amount is $2,000. That's picking up that we've earned that now. The second one is the first night of the play. Now this makes a little bit more sense around the billing and not billing because you're doing a job which lasts a couple of days and you only send the bill out after you've done the final bit of the job. One part of the job happens in one financial year. So this is a lot more reasonable that you wouldn't actually have sent out an invoice at the end of that financial year. So with this one, it's accounts receivable, which is an asset, and it's service revenue because you've done the work. And in that case, it's $1,500 and $1,500. So again, no cash being involved, and we've got a balance sheet item and a profit and loss item. Then it tells us we had $650 worth of supplies left. So if we look at the trial balance, what we'd listed was $1,000 of supplies. We only have $650 left, so we need to adjust this down from $1,000 to $650. And what we end up with is, to reduce supplies, we credit supplies, which is the asset, by $350. So that is the amount we need to adjust it down to get to that point. And we record a supplies expense, which is an expense item, of $350. So that's the debit expense, credit asset. So we've adjusted the supplies balance to reflect that. That's why companies have end of year stock takes, because they just check what's left there and then just make adjustments for things. The next one is the interest. I'll work out the number in a second. The interest expense. So we debit the interest expense because we've incurred interest on it. We've not yet paid it. We'll pay it later. If we'd paid for it, it's not an adjusting entry. It'd just be an entry. So we debit interest expense, something, credit interest payable, something. In terms of the amount, the liability was $9,000. The per annum rate was 6%. So that's the total annual interest on this would be $540. But you've only used 1 month, or this company's only used 1 month. So 45 is the amount. So we end up with $45 and $45. And the last one is they just tell us we've got depreciation, and so we have a depreciation expense. And we credit accumulated depreciation. We get told the amount, and we get told the amount. So depreciation expense, this is a teaser for next week because we haven't really done depreciation. So depreciation expense, although I say that, and we're making good time with this, so we can actually spend some time talking about depreciation. Right. So depreciation relates to assets, to non-current assets. Now, when you hear the word depreciation, when you hear about something depreciating, what's something, like if you did like a word association, what sort of things do you link up depreciation with? To yeah, sort of wear and tear. Yep. So what other things? What sort of items? What sort of assets? What sort of things do you commonly think about depreciating? Cars is a big one. Cars you often hear about depreciates in value. You may well, like, you drive a car off a lot. If you buy a brand new car, the moment you take it out of the dealership, it drops 30% in value, like it depreciates 30%. That is a commonly held view of depreciation, and it's not a wrong view, it's just not an accounting view of depreciation. So what accounting depreciates sort of relates to wear and tear in a way. It sort of does relate to change in value, but not quite in the way that most people do, is that we bought this camera, or say these two cameras, let's have a look at how much they are. So we've got $18,000 of equipment. And I think we did talk about depreciation a little bit a week or two ago. I've got a feeling we touched on it. $18,000, the whole point of depreciation is we need to figure out, we're going to use these cameras for a while. So we're going to use them for however many years. Could be more than that. 1, 2, 3, 4, 5. That's 5 years. If we're going to use them for 5 years, we need to put a portion of this cost into each year, because what an expense is recognizing the cost of something again, into those profit periods, into those periods. So if we didn't do anything with it, we just have an asset still worth $18,000 at the end, and we'd have zero expense in each period. So all the depreciation is doing is going, well, we've got to allocate this $18,000 into the life we're going to use it. That's all that we're doing. So if we say the life is 5 years, and if we think we're going to end up with cameras which are worth nothing at the end, how much is that? 3,600. So we would have an annual expense of $3,600. So we'd have a depreciation expense of $3,600 for that year. So that works out over 12 months. That's what, $300? So it looks like, if we sort of back it out, that in this case, we're depreciating these assets out over 2.5 years. But we're just allocating this amount of expense each year, and that's kind of it. Now, the way we do it is a debit depreciation expense. So this is the expense amount, but you need a credit to go with it. And what we do is we don't credit it directly to the asset itself. So if you look at that second line, the accumulated depreciation, it's not the equipment that we're crediting. What we're crediting is something called accumulated depreciation, which is what's called a contra account. It doesn't exist on its own. It's a buddy account for equipment. So when you look at equipment in the balance sheet, it will be equipment less whatever the accumulated depreciation amount is. Now, just some things to consider, and we will move into this in more detail next week, is there's 4 pieces of information depreciation need to work out this number. The 4 pieces of information are what the original cost was. For the most part, that should be straightforward, but if you go on to financial reporting and analysis and so on, you'll find that's not necessarily so. And I can actually show you from one of the examples it may not be. 2, you need a residual value. This doesn't have to be 0. It could be a non-zero number. So we need cost, we need residual. We need life, useful life, I should say. So we need the cost, we need the useful life, we need residual, and the fourth thing we need is, sort of relates to this, is we need the method used. Because in this case, we just portioned that number out equally. We just went, it's over 5 years, divide the difference between this and this, which is 18,000, divide it by 5 years, that gives us 3,600. But it could be done differently. It could be based on the number of photos you take, which seems like a pretty strange way to do it, but you could. It could be that you have something which has more usage in the early part and less usage later on. So it looks something more like that. There are different ways to do it. So the really important thing, and this is why people don't trust accounting, which is why you often see profit figures used in the media, or analysts using them. They won't use net profit, they'll use what's called EBITDA, so earnings before interest, tax, depreciation, and amortization. So what they'll do is they'll take profit, the actual net profit, and then they'll strip out depreciation because they don't trust necessarily how it's been created. And if you think about what gets included into that, it makes sense. This is relatively objective. You paid for something, we can see that. We've come up with an estimate of what we think it's going to be worth in 5 years' time. Could be a good estimate, could be a bad estimate, could be a biased estimate. We've come up with a useful life. How long are we going to use this thing for? Again, could be a good estimate, could be a bad estimate, could be a biased estimate. We've come up with a method. Again, we get choice about how we do that. It should reflect how we use the asset, but who knows. So of those 4 things that go in there, this is the only one which is rock solid, or relatively rock solid. But even then, and I just want to draw your attention to something, of the example that we did, and I'm only doing this because we've got time, and I think there's some really interesting things just to be aware of. If we look at the example that we had from earlier on, and if you look at the second transaction which took place, we purchased a building for $250,000. There's a cash deposit, and we have a liability of 5 years. We assumed that was $250,000. That's the asset value. When we have the asset cost for the building, that 250 is that number. We think that's kind of a pretty solid number. But let's assume that 5 years, it's interest bearing. Like we're going to have to pay interest to the seller to pay for that. So then the question is, should that interest, I'm not necessarily saying this is a rhetorical. So let's assume we incur $30,000 of interest on that 5-year loan for this. Should that interest cost be an expense item, so it just gets run through the profit and loss statement, or should that interest cost be added to the cost of the building? It's, again, it's not necessarily to have an answer for, because the real answer to that is it depends on the circumstances. Sometimes you could, sometimes you don't. But the point is, that number, even when it looks relatively solid, doesn't have to be relatively solid. So pretty much everything is up for grabs when it comes to financial reporting, is kind of the point. Does that make your lives easier? Well, we're not going into that detail for this subject, but it's just to be aware of it. Is this stuff's not always as straightforward as it could be. So anyway, so accumulated depreciation, it's a contra account. So leading into next week. Right, so now that we've done that, keep those in mind, and I'll put these up here. The next step is putting these into the adjusted trial balance. To make life easier, I've set this up. You guys have access to a copy of this. What you'll see is, if you look at it, the adjusted columns, so we've got the unadjusted, which is what we had from last week. I've added in extra rows as needed. This is the same as last week, 31,000. You have numbers sitting there. I've made these blank so I can fill them in. What you'll see with the adjusted columns, their formula. So that will pre-populate based on what happens and what changes I make. If you're doing it manually, obviously you'll need to make those adjustments yourself. And then it's just a matter of sequentially working through this information. So unearned revenue is a debit 2,000. And you'll see that that clears out because we don't owe a job anymore. Service revenue, 2,000. We now have more service revenue. Accounts receivable goes up by 1,500, so we debit 1,500, and we've done some more work, so that's 3,500. We end up with 8,500 of service revenue. Supplies expense is 350 debit. We end up with 350. Supplies, the asset is credited 350, and that gives us our $650 closing balance. Interest expense is a debit 45 to reflect that month, and interest payable is a credit 45 to reflect that. Depreciation expense is a debit 600, and accumulated depreciation, if I can find it, is a credit 600. The adjustments, always good to double check it. The adjustments add up to 4,495 on the debit, same on the credit. The adjusted trial balance, 33,145 debit, 33,145 credit. Sweet, all good, that balances. Once you've done that, those are your balance sheet amounts, assets, liabilities, equity. And this arguably sort of gets included in that equity item as retained earnings, which we haven't quite got yet. These, these are all your profit and loss items. Revenue less all your various expenses. So when we come down to doing the statements, service revenue 850, we're just then formatting these so they're all in there. Total expenses 3,245, 5,255 net profit. That gets added to the starting retained earnings of nothing. Dividends get taken away. You end up with 3,755 as retained earnings balance. Throw in all the assets, cash, accounts receivable, supplies, equipment, take away the accumulated depreciation. Carrying amount is 17,400. Total assets of 27,800. Interest payable 45, notes payable 9,000, 9,045 in terms of liabilities, 15,000 original contributed capital, retained earnings, the closing amount, bless you, and we end up with 27,800 liabilities and equity. Everything balances. That makes for happy accountants. Life is nearly perfect. There's one more thing we need to do. So that is, if we come back to, if I can find it, things keep moving. If we come back to this, we've already done that. We already had the trial balance. We've then done the 5 adjusting entries, or 4 of them, no, I think there are 5 of them. The 5 adjusting entries, we've got an adjusted trial balance, we've created the financial statements. The 2 critical points in this process, which will drive everything else, is getting the journal entries correct and analysing them and putting those in the proper debits and credits and the amounts. That's important. And then the adjusting entries. As long as you're getting those things correct, this flows from it, that flows from it. So those 2 points are the critical ones. Now, a quick comment when you look back at the journal entries here. These adjusted entries, okay, that's a little bit easier, that's a little bit easier. But often with adjusting entries, as compared to the journal, a lot of the journal entries we're doing, a lot of the base journal entries that we're doing, the numbers are going to be relatively straightforward. Like they're often given, it's just like they sold something for $20,000. It's just working out what the accounts are. So the numbers are relatively straightforward, it's about the accounts. with a lot of the adjusting entries, you've got to figure out the accounts, but the numbers themselves may also need some work. So the 45, you need to look at the amount of the liability, the interest rate, and the length of time you've used it. If it was accrued wages, how many days or how many weeks of unpaid wages do you have? There could be things like that. If you're talking about magazine subscriptions or Dropbox subscriptions, how much of the service have you provided? So it's not always going to be an amount which is immediately obvious. You'll need to work through that. So that's an important consideration for adjusting. But ultimately, you get those 2 points correct, that will flow. So just work hard on getting all of this stuff good. Now that is the statement, so we've done that. And the one final thing, and we're going to have plenty of time if people have questions after to finish up today. The final thing we need to do is describe the purpose of the closing process and prepare closing entries. Closing entries transfer all revenues, expenses, dividends back to retained earnings. So that's what it does, and I'll show you what happens. But the more important question for your point of view, and also understand why we're doing it, is why are we doing it? That's probably the most relevant thing. So my question to you guys is this. We've gone through, this is the end, what we've got in front of us right now and up on the screen is the end process of this film company doing various things, filming weddings, hiring people, buying equipment, doing whatever. We've done the journal entries, we've posted the ledger, trial balance, adjusting entries, adjusted trial, we come out with financial statements. So this is done for a reason. They don't just do it for the hell of it. They do it because they may want to get investment, they may want to do various other things, whatever they want to do. If you're looking at this company to either lend money to it or to invest into it, what would be kind of one of the most important numbers you'd start to look at? What number, if there's something that catches your eye here, what would be the one that you'd sort of look at first? It's a key question you'd have. Say that again? Yeah, are they profitable? That would probably be a pretty important thing to look at. Like, are they profitable? Are they making profits? Are they able to earn revenues in excess of what their expenses are? In this case, they are. Their net profit is $5,255. That is a big one. That's what we're doing. The income statement is a performance measure. We want to know how this business is performing. Which then leads us to the reason for the closing process. I'm going to step away from accounting for a second and talk about sport. So, sport is about competition. It's sort of akin to business in that respect, but slightly different. But if you have two teams playing, let's just go with football. So, across 90 minutes, across 90 minutes, it could be Sydney FC versus Wanderers, it could be someone from the EPL, could be whoever. Over a single match, and we're not talking about home and away sort of Champions League type matches where there's a home and away aggregate going on. In a single match, which team performs the best? What's a performance measure we can use for a football match? Yeah, goals scored. You could play awesomely and score no goals. The other team gets a fluky goal. The other team beat you. They performed better. So performance from a football point of view is going to be number of goals scored. Like, you could be doing all these other awesome things, but don't score anything, well, tough luck. So if Sydney FC have a match on the weekend, I don't know who they're playing, they've only got a couple of matches to finish up with. They play the Wanderers, say they beat them 2-1. Does Sydney FC start the next match it plays in the league with 2 goals to its name? No. Why not? You're one of the first people who say no, they wouldn't. So why wouldn't they?
It's a new game,
It's a new game, absolutely. So if we're measuring their performance against whoever this new team is, it's kind of not fair if they already start with 2 goals, isn't it? So we're trying to actually measure performance, and if we're going to be able to compare, if you remember back to week 1, comparability was an important characteristic of accounting information. We want to be able to compare how they do this period to how they do next period so we can see what's going on. So should Circle Film start with $8,500 of revenue already there for next year or next period? Would that be a fair thing to do? No, it'd be a pretty silly thing to do because that revenue was from May. When they start June, we don't want to include the revenue from May in June's accounts. So what the closing process is the following. It's in a nutshell, it's getting the score back to 0-all. That's what the closing process is. So with your revenue and expense accounts, I'm just going to aggregate them into one. So revenue has a balance of $8,500 on a credit. Expense, all the expenses have a $3,245 balance on the debit side. You know, save time, I'm just calling them expense. The closing process is just this. Retained earnings. This is an equity account. Now, it's only the revenue expense accounts, it's not the balance sheet accounts. These accounts exist and keep existing with their balances. It's like your cash account, your bank accounts. I'm pretty sure you'd be pretty unhappy if your bank accounts each month reset to 0. That would be kind of frustrating. So that's why these just keep aggregating. So what we're doing, all that we're doing, is turning these to 0 and moving them into the retained earnings. So what's the entry we need to get this to 0? Yeah, we need to debit it $8,500. So we debit revenue $8,500. We need to credit $8,500. Expenses of a debit balance of $3,245. So we need to, credit that $3,245, $3,245. Now, if you look at what that balance would be, that's your profit. Now, it's not. There's one more account that we need to throw in there, which is dividends. And dividends have $1,500 balance, I think it is. So to get that to 0, we credit dividends. We debit retained earnings in relation to that. We net all of this out. Actually, technically, we'd probably have, because it's a 0, I should have put, it had a 0 to start with. So for next year, it'll have a balance in there. And that gives us, and that's the retained earning balance that we have. And what we've effectively done is to turn that into 0, that into 0, that into 0, and we're ready to start next year. That's the closing process. It's just taking that account, well, these accounts, getting them to 0 so they're ready to start afresh for next year. It's getting the score to 0-all. That's it. That's the closing process. That's that little bit up there. That's why we do it. That's all that it is. Closing entries transfer all the revenue, expense, and dividend account. That's just what we just did. That's on the slide, what we just did with all the accounts included. And that is the whole shebang. That's a summary of what we've just done there. The accounting cycle is the steps in which the system captures all that information. So everything happening here, we capture it all, and then we just flow through the cycle until we end up with a set of financial statements. And then at the end, we strip things down so we're ready to go again. And then we just keep going, and we just keep going. It's a cycle. It's a never-ending cycle. And that's it.